Jim Chanos is selling well-established brick-and-mortar legacy data centers because the largest cloud providers, Amazon Web Services, Google Cloud, and Microsoft Azure, are building their own data centers instead of leasing from REIT-owned infrastructure. He believes many of these REITs and companies are overvalued and are on the cusp of experiencing a slump in revenue and falling earnings growth. To put it another way, the three largest customers of brick-and-mortar data centers are becoming its biggest competitors. EQIX is one of the brick-and-mortar data center companies Jim Chanos is shorting. This video outlines EQINX's operations, financials, equity analyst expectations, and our personal thoughts on its future. EQINX is a digital infrastructure company that provides co-location space and related offerings. EQINX provides insight for global enterprises, content providers, financial companies, and network service providers to connect their information assets. It owns or controls 244 data centers across 69 metros in 30 countries on 6 continents. Its platform uptime is 99.9999%, along with 5-layer physical security. Its global ecosystem is the most dynamic in the industry, with over 10,000 companies, including 50% of the Fortune 500, using it. EQINX also services over 2,000 networks and 3,000 cloud and IT service providers. EQINX has a proven track record of growth and profitability, including 77 consecutive quarters of revenue growth, longer track record than anyone else in the S&P 500. It also has a high recurring revenue business model, with 95% of revenue recurring and 90% of bookings from existing customers. During its company's history, EQINX has been able to diversify its customer revenue mix. It's diversified across customer region and industry segments. The company shines when it comes to its own internal developments. EQINX has achieved attractive returns of approximately 30% on its prior developments. Its development economics remain appealing and support an attractive development pipeline across the world. By looking at their current development timeline, you can see how they put their experience to work. New phases reach cash flow break-even points typically within 6 to 12 months. 12 to 18 months to fill a new phase, and stabilizing all phases of a project can take 2 to 5 years, depending on the number of phases. Maximizing return potential is easy when you have a high-quality data center asset with network and cloud-dense facilities in top-tier markets driving premium pricing. New markets provide opportunity for outsized growth and return potential. Phasing development spend improves return on capital. Finally, they're able to reduce development risks, its existing facilities at the appropriate times, so they don't overextend themselves and grow faster than what their customers demand. EQINX assets give them an ideal position with their customers because they have unused capacity that allows them to provide additional supply at previously negotiated higher rates. Management has recently updated guidance for 2022. It raised revenue guidance by $89 million and raised adjusted EBITDA guidance, excluding integrated costs, by $42 million. However, it increased integrated costs by $5 million. Management also raised guidance for AFFO per share. They raised underlying AFFO by $22 million and main one contribution of $9 million, which offset incremental debt financing costs of $22 million and higher integrated costs of $5 million. which normalized AFO per share growth of 7 to 8%. This leads to an annual cash dividend increase per share to $12.40 estimated for fiscal year 2022. For the next 12 to 18 months, the dividend looks safe. However, there is concern for Equinix long-term model, and people are starting to talk about that. Citigroup is not worried about the recent pressure on Equinix and continues to believe in the future growth of the company. Citi analyst Michael Rollins noted data center stocks Equinix should be fine because he does not see any risk for the category. He believes these sizable hyperscale cloud customers will likely stay customers and competitors within the data center ecosystem, as many enterprise firms seem likely to employ hybrid cloud architecture. He prefers retail-centric data center assets that can differentiate their portfolios around ecosystem and high levels of connectivity, that is, the network and cloud. And Equinix falls into this category. Although Citi remains very high on the stock, it seems that the downgrades from 2021 remain. And therefore, Credit Suisse, Oppenheimer, Cohen, BMO Capital Markets, and Jefferies have not reinitiated at a higher level and have not taken their unfavorable ratings of perform, neutral, market perform, or hold off and replace them with an outperform rating. These analysts are expecting the price of the stock to settle somewhere between $731 to $850, pending the different assumptions you make. I personally would not short this stock, mainly because of the high institutional ownership. The chances of having a short squeeze are very high. I also probably would shy away from buying the stock until we can confirm that the churn rate will not explode in the next 18 to 24 months. There is reason for concern of the churn rate to go significantly higher because the competitors that are entering this field have two things. Google, Microsoft, and Amazon have lots of cash and access to the debt markets for even more capital for their own projects. The second point is that Equinix has the same customer base as Google, Amazon Web Services, and Microsoft. And if those three companies decide they want to vertically integrate and their customer base is on board with that, they're going to give up Equinix and just go with those three large cloud providers, which would really hurt Equinix's business. Time will tell whether the big three technology companies currently providing cloud services will win out and take away Equinix's business by vertically integrating. Thanks again for listening to this video. We hope that it's helpful for you to understand the current situation that we see in the market, and hope that you subscribe to the channel and like this video. Feel free to leave a comment and tell us the type of content you'd like to see from us in the future. We're always looking to please. Thanks so much for your time, and have a good day.